We now shift our focus on a surprising development in the U.S. economy, inflation, which many hope was on the decline. It has picked up pace unexpectedly this August. This could have implications for Federal Reserve policy and your wallet. The U.S. Bureau of Labor Statistics reported that the core consumer price index, which includes volatile food and energy prices, rose by 0.3% from July and increased 3.2% from a year ago. The core measure is often viewed as a better reflection of underlying inflation trends than the overall OPI. The rise in inflation was largely driven by higher housing costs. Rentals was identified as the main factor behind the overall increase in last prices this month. The last month. In contrast, the overall consumer price index climbed 0.2% from July and 2.5% from a year ago. The figure has been trending lower for the past 5 months, primarily due to falling gasoline prices. So what does this mean for interest rates? With the uptick in core inflation, the Federal Reserve is likely to cut interest rates by 25 basis points next week. The focus will likely remain on labor market conditions, which are a major concern for policymakers. Following the report, trade adjusted their expectations, reducing the chance of a jumbo rate cut next to near zero. This caused Treasury yields to rise, S&P 500 futures to edge lower, and the dollar to recover some of its losses. For consumers, this means that while gasoline prices are lower, you might still feel the pinch at home due to rising shelter costs. The economic landscape remaining complex, and ongoing adjustments by the Federal Reserve will be closely watched in the coming months. For all the latest news, download the WION app and subscribe to our YouTube channel.